All right, let's look at the data. You know, in a market that's just flooded with conflicting stories, the most critical skill is separating the signal from all that noise. So today, that's exactly what we're going to do. We're cutting through the chaos and looking at the underlying mechanics.
So on one hand, you've got these insane speculative frenzies. I mean, look at this. A stock trading at 1,240 times its annual revenue. That's completely detached from any kind of fundamental reality. This isn't investing, right? This is pure narrative momentum.
But then you look at the other side of the coin, and the real economy is flashing some pretty serious warning signs. The manufacturing sector, a pillar of the economy, is signaling a major prolonged slowdown. And that is a serious divergence we have to pay attention to. And then underneath everything, there's this layer of just informational chaos. We're talking about foreign bot networks that might be driving a huge chunk of what you see online. It makes it almost impossible to know if the narrative you're seeing is even real.
So that's the big question, right? How do you find the real signal in this wall of noise? Well, to do that, we have to break down the mechanics of these conflicting forces. We've got the hype, we've got the real economy, and we've got these political wildcards.
Okay, first up, let's break down the speculation engine. We're going to look at assets that are running on pure narrative, sentiment, and speculative flows, where, the old valuation rulebook has just been tossed. Let's be really clear about what this number means. 1,240 times sales. The market is valuing this company at 1,240 years of its revenue. I mean, that's not just high, it's a profound market anomaly. It signals a complete disconnect from the fundamentals of the business. Honestly, this is the kind of stuff you usually only see with like a pre-revenue biotech firm or some wild crypto meme coin.
And if you look at their own filings, their 10Q, it just confirms this divergence. The data couldn't be clearer. Revenue's down, expenses are way up, and losses are getting bigger. From a purely financial standpoint, this is not a growth story. It's a story of some serious headwinds that the market is just completely ignoring.
And look, this crazy volatility isn't just in the stock. It's spilling over into related meme assets. And these things, they're basically a barometer for pure speculative feeling, because they have zero fundamental value. The fact that they've collapsed just shows you the massive risk you take when you're chasing a narrative that has nothing backing it up.
All right, so enough of the speculative noise. Let's pivot and focus on the real signal, the stuff coming from the actual economy. This is the hard data, the kind of data that big institutional money simply cannot afford to ignore.
Okay, so this quote right here from the chief economist at S&P Global, this is a huge red flag. He's pointing to a really clear structural problem. Companies are making stuff that they just can't sell. And when you see unsold inventory piling up like this, historically, that's a leading indicator for production cuts and a slowing economy. And this isn't just some abstract number on a chart. This is a real-world consequence. I mean, a 75-year-old company with 120 stores just filed for bankruptcy. That tells you that these big-picture pressures, tariffs, slowing demand, they are hitting real, established businesses on the ground hard. Now let's talk about the consumer, because there's this silent squeeze happening. The data here shows that the hidden costs of just owning a home are now over $21,000 a year, on average. And the biggest piece of that? Maintenance. Which makes sense, right? The median home in the US is over 40 years old. And here is the critical divergence. The official inflation number, the CPI, it pretty much ignores these crushing costs. It uses this weird hypothetical metric called owner's equivalent rent, or OER. What that does is create a huge gap between the inflation numbers you hear on the news and the actual financial pain that millions of households are feeling. This isn't just a technical thing. It's a massive blind spot in how we measure inflation.
All right, last piece of the puzzle. We have to layer on something that isn't strictly economic but can create huge volatility: political risk. Think of it as this unpredictable X factor that the smart money absolutely has to account for.
So recent data has uncovered these big, coordinated social media campaigns run from overseas, and it looks like they're financially motivated. These networks are actively shaping what people are talking about online. That creates this thick fog of informational uncertainty, and it can directly move the needle on politically sensitive assets. And it's not just on social media. We're seeing reports of some serious instability within our institutions. I mean, when you have dozens of career lawyers at the Department of Justice talking about a culture of fear and a brain drain, that's a huge non-financial risk. It can really shake market confidence in the stability of the rule of law itself.
And of course, big political decisions can have very direct, very immediate market consequences. Take this example, the pardon of a major crypto figure. When that happens after a series of events that just so happen to boost a related business venture, well, that sends a really powerful signal about regulatory risk, and it directly hits a very specific and very volatile part of the market.
So this brings us back to the central problem, right? How do you take all these conflicting pieces, the speculative craziness, the weak fundamentals, the political risk, and put them together into one coherent view of the market?
I love this quote because it's a call for discipline, plain and simple. In an environment as chaotic as this one, your only real edge is to focus on objective, data-driven analysis, not emotional, narrative-driven vibes. You have to find the signal in all the little details.
And this really boils it all down to two competing stories. You've got the bull case, which is powerful and simple, a massive, once-in-a-generation tech boom with AI that could just power through all the problems. And then you have the bear case, which is grounded in all the fundamentals we just talked about, the manufacturing slump, the squeezed consumer, and all that political and institutional risk.
So at the end of the day, navigating this market really comes down to this one question. Are you reacting to the noise, or are you listening for the signal? The noise is the speculative hype, the social media drama. The signal is in the economic data, the inventory levels, the real risk factors. Which one are you paying attention to?
Now, just a reminder, this is a snapshot. It's based on the data we have today, and this environment is changing incredibly fast. So this is all for educational purposes. You've always got to do your own due diligence.
We are tracking these flows in real time. So, while you're analyzing the next move, check out the tools in the description. You can sign up for Public to get $20 in free assets, check Webull for that BTC promo, or look into NVDA on Moomoo. All the links are down below. And hey, like and subscribe for more of these deep dive analyses. Stay disciplined, stay liquid.